earlier, Samantha Loring caught up with Mei-Chi Liou, portfolio manager at Futuregrowth, asking her where she can find real returns outside of the equity environment.
I think there are broadly speaking, three key value-adding areas. The first would be your normal interest rate views and bets, and your yield curve-related bets. So whether you want to go long or short the ALB, whether you like particularly one bond over another bond. Then you could add credit to your portfolio, and finally you could maybe take some off benchmark bets, since like inflation-linked bonds, for example.
Your background is in credit, which is essentially corporate debt, and you refer to credit analysts as pessimists, whilst on the other end of the spectrum you have equity analysts, which you say are optimists. Why the key difference there?
Well, I suppose the difference between credit and equity is that the best that a credit analyst can do is get their money back, plus the interest that they wanted to earn in the beginning. Whereas an equity analyst, they have kind of blue skies. They have, if the company does very well, they're able to achieve lots of returns. So that's why equity analysts tend to be more jovial and happier, and why credit analysts might be a little bit more pessimistic, because they're always worried about whether they're able to get their money back. They can only see downside.
So if we're talking about risk, how risky is credit or corporate debt against other assets?
It's actually not that risky. I think people are very comfortable with the idea of shares and investing in shares, but they don't actually realize that there's a whole cash flow waterfall when a company defaults. So when you're investing in credits, you are actually standing above the equity holder in a default situation. So obviously excluding the government, for example, and the taxes and all the things that the government and taxman can take, a bondholder or a credit provider actually is able to access, assets and get access to cash flows before the equity holder. So in terms of risk, it's actually a lot less risky than the equity market. And over and above that, you're able to negotiate for certain covenants and terms and security as well. Let's say you can take a mortgage over a house, for example, which helps your risk.
When we're breaking down the credit markets, what type of credit is available?
Well, you do have, broadly speaking, you can break it down into listed bond market and unlisted bond market. The difference between the listed and the unlisted bond market is that the listed market, they need to go through a regulatory hurdle. They need to perhaps disclose a few things. They need to give regular reports, and perhaps they're just more visible. Their legal structure is more visible. And on the unlisted side, it's less so, but you're able to negotiate for more terms and conditions on the unlisted side. And it doesn't necessarily mean that only small companies would do unlisted debt, for example. You have large corporates, names that you would know, MTN, Vodacom, for example, who all have unlisted debt at one stage or another. It's just really about whether they're visible or not.
The South African listed bond market has really grown exponentially in size, looking at a size of 36 billion rand in 2002, growing to 301 billion rand at the end of September 2011. Is this a function of new listings?
I wouldn't actually necessarily say that there's a strong growth in corporates per se. That bond market has grown because of the maturity of the market. There is a large percentage, I think close to 60% of the listed bond market is actually government debt. So the diversity in the listed bond market is perhaps not as great as you would expect it to be. So, with parastatals, with all the funding that's been required to grow the infrastructure of the company, you get a natural progression and growth of the listed bond market.
So how do you weigh up the positives and negatives in terms of investing in listed and unlisted credit?
That is very true. A lot of the listed bond market is geared towards banks or securitizations, which are, bank-originated mortgage loans, for example, or conduit papers. So there is a large exposure to banks, basically, in the listed bond market.
So when you're looking at structuring a portfolio, and you're looking at in terms of how much of the portfolio you want to assign towards credit, what are the key questions you need to ask if you're managing a portfolio, if you're looking at the portfolio in terms of the percentage that you'd be willing to allocate towards corporate debt?
Well, just remember that by adding credit to a portfolio, you are actually adding risk. So depending on your risk appetite and the risk versus reward sort of trade-off, you can make that decision. You can say, well, I'm less risky and therefore I would like less corporate bonds, or I'm more risky, I want to have more returns and I would like more corporate bonds. So things you need to ask when you want to invest in credit would be, how much credit would you like in your portfolio? It could be anything from, 20% to 80% or even 100% if you want. You need to ask about the credit quality that you're willing to invest in. Would you want investment grade credits, or are you willing to go down a little bit more down the spectrum? You also need to ask yourself, whether you want to invest in listed or unlisted credits as well. It really depends on the mandate and the risk appetite that one has.
You mentioned investment grade corporate debt. How seriously do you take credit ratings from ratings agencies?
It's very, very important to have an independent view, one's personal view about a specific company. It is quite an interesting input. It's good input to have rating agencies and what their ratings are. But at the end of the day, one needs to take responsibility for your decisions and make your own views.
In terms of the attractiveness of investing in credit, in around 2008-2009, you had AA rated corporate debt with a spread of around 250 basis points above government bonds. That's fallen sharply to around 50 basis points, that spread. So what is the incentive in terms of returns for investing in corporate debt, credit versus other assets?
Well, I think, at the end of the day, when you want to have a return, you have a return target, you need to find assets that are showing relative value. So at the moment, the listed bond market is perhaps not showing as much value as it did during the credit crisis, when it was showing 250, 300 basis points. And so perhaps now is the time to go into unlisted credit, where more of the returns can be made.
So if you're a retail investor, there are a lot of ways to get exposure to credit or corporate debt.
It is more of a wholesale product. I am not 100% sure if there are any funds out there that do a lot of unlisted, because at the moment, with the Cisco regulations, they kind of limit the amount of unlisteds that you're allowed. But I think those regulations are being busy rewritten or looked at, and we could potentially see more unlisted credit.
Looking at Futuregrowth's yield-enhanced bond curve, you're sitting with a 3-year real return of 4.5%. What do you think the key drivers of this real return of 4.5% was?
I think, at the end of the day, the performance comes from a stew of different strategies. Everything, as I mentioned, from interest rate decisions, yield curve bets, to credit. And I think that particular portfolio is able to do very well because it has access to, I think, 60 or even 70% unlisted credit.